because you're watching your portfolio go potentially down much faster and much farther than you're comfortable with.
And by not having, I think, an appropriate tax strategy, it could cost some retirees hundreds of thousands of dollars over a 30-year retirement.
Chances are, during our retirees' lives, they're going to go through a few more bear markets, and you want to make sure that you're being prepared and that you are aware of the risks that your portfolio entails.
Welcome to Retirement Done Right with your hosts, David Rath and Pat Kalish, where we talk about retirement, Social Security, taxes, estate planning, wealth planning, and more. Now, onto the show.
On today's episode, we are going to talk about some of the biggest mistakes that retirees make, either when they're just entering into retirement or maybe a few years in. Pat, what are some mistakes, or what would you say is the biggest mistake from your seat that retirees make?
Biggest mistake, David, I would say, is not having a tax plan, not having good tax strategy going into retirement. What do you think?
Well, hold on a second. We'll probably go in deeper into this in the future, but when you say not having a tax strategy, can you explain that or unpack that a little bit?
Yeah, I think a lot of times when retirees, finally make the jump into retirement, they focus in on just like a few key points, maybe claiming Social Security or, picking the right investments. But a lot of times it's a larger issue and so much changes, right? Because when a client is working, they're collecting a wage, they're having taxes withheld from their paycheck, and then they file their taxes at the end of the year. But when a client then retires, they're meant to now create their own retirement paycheck. And a lot of, variables go into creating that retirement paycheck. And a big portion of that is tax planning. Where are you going to pull your where are you going to pull your funds from? In what order? How much? And I think a lot of retirees are not ready to kind of take on those decisions. And by not having, I think, an appropriate tax strategy, it could cost some retirees hundreds of thousands of dollars over a 30-year retirement. And I think it's just something that's not talked about enough and is one thing that really goes overlooked.
And that's real money. You mentioned hundreds of thousands of dollars. That might be
Yeah.
an extreme case, but sometimes tens of thousands of dollars. It's enough to move the needle for people.
And
I'm not
David,
surprised you
I
went
don't
with the
think it's
tax
an
strategy.
extreme case either. Like,
Yeah.
I run a lot of analysis, this, and it definitely depends upon your net worth. It really does. And for some, it might just be tens of thousands of dollars. But if you have a substantial net worth and you're not being proactive in terms of how you're taking distributions and how you're trying to strategize long term from a tax perspective, I mean, it's a significant chunk of change, especially when you're thinking about planning for a 30, 40-year retirement.
Yeah. I always like to make the analogy, if you saw that money laying on the ground, you'd pick it up, right?
Yes, amen to that. And it's money on the ground. You
Yeah,
just got to plan for it.
that's for sure. I'm not surprised to hear you say that as the number one mistake, being that you are soon to be sitting for your second level of the TPCP,
Yep.
which is a mouthful to say. Can you explain what that is from your seat and how that helps you in your role?
Yeah. So, like probably most of our listeners know, I'm a certified financial planner, and I really love to go deep on comprehensive, call it, financial planning topics. But the one thing that I think that I thought was missing kind of in my arsenal was just a better approach and a better understanding of how taxes impact not just retirees, but anyone that's planning from a more holistic standpoint. So the TPCP is really meant to focus in on long-term tax strategy. The first section was for accumulators, and I got through that, filled with great information. This section that I'm sitting for, actually, I'm taking the test on Tuesday, is for retirees. And then finally, the last session is for kind of your one-offs type of special situations. And what I really love about it is it's not so much about how do we capitalize on tax planning for the current year. It's how do you look at tax planning from a longer term perspective? And really, what has dawned on me by taking this course is you really need to take a longer term view on how you put together a tax strategy because that is where the money is made. It's all about trying to save someone in terms of their lifetime taxes, not just in each individual year. And as you know, I'm super excited about it, and I've just learned so much. And I'm interested in continuing to apply it with the people that I work with.
It sounds like a Star Wars robot, but it's really useful for what you do, specifically in your role internally here. I'm going to go a different direction for this question. Obviously, as the investment guy here at Continuum, I think one of the biggest mistakes people make is being complacent with their investments. So a similar story as yours, which is everybody just expects to coast, and things that are going to work themselves out on the tax front, on the planning front, but also on the investment front. And especially now that we are in year 17 or whatever you want to call it of a bull market, especially that every dip that we've seen in the market in the last few years has been aggressively bought. It's conditioning people to be complacent in their investments. And I'm here to tell you that it's not always going to be like this. I don't know if that ends tomorrow or 10 years from now, but chances are during our retirees' lives, they're going to go through a few more bear markets. And you want to make sure that you're being prepared and that you are aware of the risks that your portfolio entails.
Yeah. I'm not surprised you picked the investments, the CFA, CMT on the team. You brought up something interesting today when we were chatting about the S&P. And I think a lot of people are just focused in on S&P, 500 returns. I actually think our audience would actually like to hear a little bit more about maybe your take on that and how you see the trajectory of trying to protect maybe against some risk out there kind of plays into your strategy.
And let me just preface this by saying the S&P 500 is a fine investment. It is a very cheap way to access the market. We have it as part of our portfolio, but it's just a part, because the more that you are tied to the performance of one subsect of the stock market, and that would be the large US companies, the largest 500 companies, the more that your fortunes are going to be tied to the performance of those stocks. And we don't have to look that far back in history to see a period of time in which a retiree's net worth could have been cut in half. And that was during the global financial crisis in 2008. But there is numerous instances of that throughout history. And so my stance is that you can invest in a passive manner and things will eventually work themselves out, but you're probably going to be losing a lot of sleep at night, wringing your hands, pulling your hair out, however you want to term it, because you're watching your portfolio go potentially down much faster and much farther than you're comfortable with.
Yeah. I think we could battle it out in terms of what's more important. And we both have our fortes here, but you said this now twice when you were talking about the investment strategy is complacency. I feel like we should dive in to that topic a little bit more because I hear it all the time, David. I have a lot of people that will come to me and, hey, I'm just going to keep doing what I've always done. Or, from the tax side, a lot of people think my taxes are going to be lower in retirement because now I'm not working. What are kind of some of the common complacency, call it, terms that come up when clients that you're working with from the investment front?
Well, we talked about this a little bit in our AI episode, but people think that they're going to get a portfolio that works for them in their situation from a conversation with ChatGPT. And as I mentioned in the episode, you can get a reasonably diversified stock and bond mix that is going to not kill you, so to speak. It's not going to be the worst thing in the world, but it's probably not going to be the best thing either. And it's not taking into account your personal situation, your feelings about risk, and then also what you're going to do when things start to go south. That's the biggest thing. It is so easy to be a buy and hold investor during a bull market because everything just ends up going up and to the right. I would love to see those people who are relying on ChatGPT for their portfolio allocation to have that conversation as stocks go down 5, 10%. See what comes back from the chatbot. Because one tendency that these chatbots have had so far is to agree with everything that you say, right? And so let's say that the market's down 20, 30% and you're freaking out. Now your advisor is some line of code in a large language model. and you start asking it, should you panic and sell? It's going to give you the highest probability answer to that situation that it's scraped from its world of trained data. So that's probably the most the thing at the thing at the forefront right now. But there's been the passive revolution for a long time with investments. I'll just put it in some index funds and everything will work itself out. And that is normally true. If you look throughout history, things end up recovering, they come back. But in that moment, in real time, when the market's down 50% and your blended portfolio is down 35%, as we saw in 2008, try being a passive index funder then, a fund investor then. It's a lot harder than it sounds. And so being complacent to me means that you're just going to set it and forget it and withdraw some money from your portfolio every year and live a happy life. Well, try not looking at your portfolio when you're watching the news and seeing that the market's selling off. And now you're really worried about how much money you're going to have and if it's going to last your entire retirement.
Yeah. What you said at the end too resonates, because I think a lot of time when people are working, like, they're making deposits. So like if the market sells off, they still have a steady paycheck that's probably covering the majority of their living expenses. Maybe a lot of accumulators think, well, hey, the market sold off. This is a great buying opportunity for me because I'm still making deposits into my account. But then when you retire, things change. It goes from deposits to now withdrawals. And at least from my experience, I have seen people really change their attitude towards investing when the market sells off and they're having to take distributions from the account in order to fund their living expenses. So I think psychologically it definitely changes. And I think complacency, happens with those retirees at the beginning of their retirement, especially as things are going well, until things start to get a little bit rocky. And then they're like, man, I made some big mistakes here and now I need to course correct. And unfortunately, sometimes it's a little too late. So,
And not even just psychologically, mathematically.
yeah.
There's this sequence of return risk, which is that if you retire right before a bear market, your retirement picture looks a lot different than somebody that retires in the middle of a bull market. It's just the math that works out because now you're drawing from that portfolio. The money that you take out is being forced to be sold at lower prices, and that money can never recover because you're spending it. So that sequence of return risk is real. Talk to anybody that retired in 2007, right before the housing bubble burst.
Yeah.
Ask them about their experience. Probably not great. I would guess that probably a lot of them went to cash in fear that their money was going to run out. Because what a lot of people don't talk about when it comes to drawdowns in the market is it's not just the market going down. That is a symptom of the bigger disease at play, which is the turmoil in the world economy. In 2008, we thought that the global financial system was going to collapse. It wasn't just, hey, my stocks are down, it's going to come back because we're in a good economic time. No, it's like the world is ending. I need to make sure that my money is safe. Yep. So that's what forces people to make the poor decisions with their emotions.
Yeah, I'll bring this up too in terms of complacency. So I'll bring it back to the tax side. I see this a lot. So when you first get into the workforce and you start your first job, you may have like a 401k. And the whole goal is, hey, let's put a certain percentage of your salary into the 401k. Typically, it's automatically set up to go in pre-tax. So we're almost ingrained to think about tax deferral, right? Like you put your money in pre-tax, it continues to grow with the hope of when you retire, you're in a lower tax bracket and you take out that money at a lower tax rate. But I look at that as kind of a disease because people are so ingrained with this concept of tax deferral that they hit retirement. And a lot of retirees, they might not be tapping into those retirement accounts first because they want to continue to defer the taxes. So they might be taking from CDs or taxable brokerage accounts to cover their living expenses. But then required minimum distributions start. And then Houston, we may have a problem. You may be in a far higher tax bracket when those required minimum distributions started, and you're not taking advantage of maybe when you were in a lower tax bracket when you first started your adventure into retirement. And I look at that as a form of complacency. And unfortunately, I think it's just ingrained in many people's psyche that tax deferral is a good thing. And don't get me wrong, it is, it plays a part, but you need to take advantage of some of those lower income years to really set yourself up for long term success, at least from the tax front.
And it paints a somewhat unrealistic picture of your household finances if you're looking at the balance in your pre-tax IRAs and 401ks. Let's say you have $1 million in pre-tax. Guess what? That $1 million is not yours. A good chunk of that, a good chunk of that is going to go to the government. And unless you plan around that, and something that we can talk about right now, which is being proactive about your tax strategy and not just paying your taxes on a year-to-year basis and looking at the entirety of your retirement years as limiting that tax bill and not taking taxes as they come to you. Can you talk about that for a second?
Two things, that I want to touch on. I love that you brought up that point. I think there's also some complacency that comes with, you had a certain number in mind. Let's say it's $1 million, right? And you're like, once I hit $1 million, I am ready to retire. But you did no planning around it. Well, what does that $1 million actually mean to you? Like, how are you going to be able to create now an income stream based off of that $1 million? How long is it going to last? How much can you pull out? And if you're not doing that planning before retirement, you're kind of just shooting in the dark and hoping that it works. And I think more planning needs to really go into that. And a big part of what we look at is, okay, you have $1 million, but what's in your pocket at the end of the day, ready to spend, and how long is this thing going to last, so that you have better expectations. On the flip front, I would say the one big miss for retirees is those first couple of years, at least what I've seen, because income can be incredibly low. Like I mentioned, you might be continuing to defer touching those retirement accounts. Let's say you retire at 65, you might be deferring Social Security to your full retirement age at 67, and you're sourcing a lot of your income from, call it, CDs or taxable brokerage accounts. Huge missed opportunity. I think a lot of people, and I've had a few come up to me and they're like, Pat, you'd be really happy. Like, you love talking taxes. I didn't pay any taxes. I had no federal tax. And I'm like, man, that is a missed opportunity. Because for a lot of those clients, what they can think about doing is taking advantage of those very low tax brackets, the 10, the 12, even the 22 for some, and maybe doing things like Roth conversions to help re-diversify their tax portfolio and lower RMDs in the future. Or even you might have low enough income to qualify for the 0% long-term capital gains rate. You could be taking income out of appreciated investments and not owing a dime in federal taxes. So I really see that as just such a huge missed opportunity. And unfortunately, for many retirees, it's only a few years. For some, it's only maybe, 5, plus years that you might be able to leverage these strategies. And once it's gone and those RMDs kick in, you don't have as much flexibility.
And this is information that's out there. You can find these strategies, and we always talk about this. The money is made, or the money is not spent in taxes, in the implementation. So working with somebody that is able to look at your entire situation and make recommendations based on what they know about the tax code, what they're learning in the TPCP, that's important, because it's an easy mistake to make, and it could be a very expensive mistake if you try to DIY this and go with some information that you saw on a message board because somebody was giving tax advice. And so be very wary of taking advice from somebody who doesn't know you and your situation, because each individual is going to be different and their tax situation is going to be different. And the IRS is not somebody that you want to make a mistake with.
No, I'm glad you brought that up because, we're talking taxes and we're talking investment planning and two big mistakes that could occur. But I think it's really important to take a really holistic view. From my side on the tax front, I'm always coming over into your office and I'm saying, hey, David, like, this is kind of what we're wrangling with from the tax front. We need to make sure we're not incurring X amount of capital gains, whatever it might be, so that we're kind of locked in from the investment front. But then we also have to make sure that we're communicating with estate planning attorneys. There's so much that goes into it. So I think having a really holistic view is so important. And I've talked to a lot of people where they might be working with someone and it's like, well, they're only focused in on the accounts that they're managing. And I'm like, how do you even do that? Because if you have accounts elsewhere and there's other goals that are on the horizon that they don't know about, how can you take a more holistic approach to your overall comprehensive plan? So I think it is so important to really ensure that you're taking into account everything as a part of your overall plan, not just one thing in a silo.
You mentioned the window that exists usually for somebody who just retired. Maybe before they start Social Security, how would Social Security play into a discussion about taxes and the planning for taxes? And how does that incorporate into their overall picture?
Yeah. With Social Security, for many people, they just look at break evens, right? They say, like, if I claim at, 67, and I live to age 75, like it broke even. Like I take it to the next level. I think break evens are important to start the conversation. But when you start Social Security, remember, once you start, you typically can't go back. So then you have some forced income from the overall federal government that then you're having to plan around. So if you didn't have that income in the first place, your income's going to be lower. So it might afford you the opportunity to do some of the strategies that we spoke about. The other thing that I always touch base with clients on in terms of Social Security, and this is, my opinion, but for the many plans that I've built, the clients that tend to have a higher level of stable income, Social Security benefits, pension benefits, they tend to spend more because it's almost like a paycheck and they know it's going to hit their account every single month. So I like to have that conversation as well to better understand, are you going to be that client that really struggles to spend from their portfolio and will potentially higher Social Security benefits allow you to just live an overall better life? The other aspect to this too is what they call the Social Security tax torpedo. A lot of people don't know about this, but when they start to claim Social Security and say the whole portion is, say, 85% of it's not taxed, that's the top end. By including additional income, it causes more of your Social Security benefits to be taxed, and that could really spike someone's overall effective tax rate. So there's just so much that's in play both before you start claiming and both during, and actually then when you start to claim Social Security, that really just has to be taken into account.
You mentioned this during the seminar that we give on taxes in retirement. And if anybody is interested in seeing the full version of this, we do have a recording that we can send. So reach out to us and we can send you a recording of this. But you talk about the complexity that occurs for a retiree. And it's almost counterintuitive because during your working years, it's usually pretty straightforward. You get your paycheck, you get your W-2 at the end of the year, and you file your taxes. Now, some lever pulled in one arena of your life can affect things in your other arena. And that can be an irrevocable decision like the Social Security. So you might say, I'm worried about Social Security running out. I'm going to claim my Social Security benefit and not factor in some of the other things, especially from a tax angle. Or maybe you claim it before your full retirement age and you're still working and you've just locked in a lower benefit throughout your life and you have to give all that money back. Now, of course, you get it once you eventually retire, but now your monthly benefit's locked in and you just made an irrevocable decision that's going to cost you thousands of dollars throughout your life.
Yeah. There's so many different aspects to it. And that's why it's not just one piece. And even like we're talking Social Security, there's a lot of people out there with pensions too. Those are big decisions that you have to make in terms of survivor benefits and things along that sort. So I think just having a conversation, again, not in a silo. How is this going to fit in with the rest of your plan from an investment perspective, a retirement income perspective, a tax perspective, so that you can really feel like you're making a very confident decision. I have another question for you. And David, you mentioned this, and it struck me that the sequence of distributions, or call it the sequence of return risk, How do you think about that, right? Like we've hit some volatility in the market just over the past 2 weeks. And I think there's definitely some retirees out there that are concerned with what's happening in the AI trade and the war in Iran. So how do you think about trying to potentially protect those investments, especially for a newer retiree that's just making this jump?
You need to have a plan in place before things start to go south. If you're
Yeah.
reacting to whatever is going on in the markets and in the news, chances are you're going to make a mistake. And that mistake is going to be selling to alleviate the pain that you're experiencing in that moment. Selling's the easy part. It's getting back in. That's the hard part because there is never going to be an all clear signal in the stock market. And ironically, when there is, it's usually the worst time to be invested. When things look the best, it's usually the worst time to be invested. And so the sequence of return risk is simple math and protecting your investments with a strategy that is going to hopefully limit the downside of your total portfolio.
Right.
And this can come in a variety of different forms. It can be invest in a diversified mix of assets that things aren't going all in the same direction at once. It can be proactive about risk management and using a system where you're limiting that downside from a proactive basis. One of the biggest mistakes that people make is saying, well, the market always comes back. It does. Totally get that. I'm a student of history. But I also know that there's been periods of time where it takes a long, long time to come back, and not just stocks and bonds. So you want to be looking at other asset classes and other strategies that can hopefully offset some of the losses in the stock and bond market. We saw a glimpse of this in 2022. When interest rates went up, the stock market came down. Excuse me. Stock market came down. You watch stocks and bonds go down together. There was another episode like this for an entire decade in the 1970s. Again, things came back. Bull market starts in 1982. But if you're experiencing that period of time during the 70s and you're watching not only your stocks go down, but your bonds, which are supposed to be the stability portion of your portfolio, they're just getting eviscerated. Try to be a buy and hold investor, or try not to have a plan through that scenario. Now, again, there's different ways to approach this. And if we bring in the planning aspect, you can structure your withdrawal strategy to accommodate for ups and downs in the market. When the going gets tough, you tighten your belt and maybe spend less. But is that something that retirees want to do, is limit their lifestyle because their portfolio's down? And again, we have a tendency as humans to extrapolate recent events into the future. So we'll watch the stock market and the bond market maybe go down and our portfolio decline. Well, in our minds, it's going to zero. Like things are going to get infinitely worse and my portfolio is going to go to zero. I need to withdraw everything, pay the taxes on it, and hide it under the mattress. That's when the biggest mistakes get made. The other mistake is thinking that, well, it's just going to come back. We've been so conditioned in the last 17 years where things do come back, and they usually come back pretty quickly. We had the COVID episode. It was back within a few months. We had the tariff tantrum last year, back within a few months. Iran this year, back within a few weeks. But guess what? It doesn't always work out like that. And when the big one does come and you say it always comes back, you might be waiting 5 or 10 years before your portfolio gets back to where that level is.
Yeah. I think the one thing that really hit me is at the beginning, you said like you have to have a plan before it starts. And I think that's where like complacency really hits in, because a lot of times people don't really even think about their retirement plan until they're ready to retire. And at that point, like don't allow a market event to then throw off your goal of retirement. I mean, that's a really tough spot to be in. You led with investments. I led with tax strategy. I think I come away with both are incredibly important. And I just think having a comprehensive look is the most important thing. But then I think the undertones to this is the biggest mistake that retirees can make is complacency, right? Like thinking that everything's going to be okay. The investment strategy has worked. It's going to continue to work. I'm going to pay less in taxes throughout retirement. I have enough, but I didn't plan for it. I really think at the end of the day, it boils down to just complacency and not taking a deeper dive into your overall comprehensive situation.
I like to call it the ostrich strategy, where you just bury your head in the sand, and hopefully when you pull your head up, everything will be fine again.
We're good. Yeah.
But yeah, that's going to be, I agree. The complacency is probably the number one mistake across all areas of finance, because unless you are aware of the risks that you're undertaking, the chances that you make a mistake in the heat of the moment probably increase unless you had a plan in place beforehand.
Yeah, amen to that. Well, I think we cut it there.
All right. Well, good to talk to you guys. If you have any
sure.
questions, feel free to reach out to us. Be sure to subscribe to the podcast if this is your first time hearing it. If you're on YouTube, give us a subscription as well. Pat and I did not plan to wear the same colored polo today, but that's the way it works sometimes.
Good.
So
let's go.
Look forward to the next episode. Take care.
Awesome. Thanks, David. See y'all.
Thanks for joining us for another episode of Retirement Done Right. To learn more, visit us at contwealth.com.